Well, good morning and welcome to the Reserve Bank, and a special welcome to the students of King's College who are winners of this year's Monetary Policy Challenge, which is a competition that we run throughout New Zealand through New Zealand high schools. With me I've got John McDermott, who's the Chief Economist of the Reserve Bank and also the Assistant Governor. The Reserve Bank today reduced the official cash rate to 2.75%. Global economic growth remains moderate, but concerns about softer growth, particularly in China and East Asia, have led to elevated volatility in financial markets and renewed falls in commodity prices. Financial markets remain uncertain as to the timing and impact of an expected tightening in US monetary policy. Domestically, the economy is adjusting to the sharp decline in export prices and the consequent fall in the exchange rate. Activity has also slowed due to the plateauing of construction activity in Canterbury and a weakening in business and consumer confidence. We think the economy is now growing at an annual rate of around 2%. Several factors continue to support growth, including robust tourism, strong net immigration, the large pipeline of construction activity in Auckland and other regions, and importantly, the lower interest rates and the depreciation of the New Zealand dollar. Further exchange rate depreciation is appropriate given the sharpness of the decline in New Zealand's export commodity prices. House prices in Auckland are increasing rapidly and becoming more unsustainable. Residential construction is increasing in Auckland, but it will take some time to correct the imbalances in the housing market. Annual CPI inflation remains below the 1 to 3% target due to the previous strength in the New Zealand dollar and the halving of world oil prices since mid-2014. Headline inflation is expected to be well within the target range by early 2016 as the earlier petrol price decline drops out of the annual inflation calculation and as the exchange rate depreciation passes through into higher tradables prices. A reduction in the OCR is warranted by the softening in the economy and the need to keep future average inflation near the 2% target midpoint. At this stage, some further easing in the OCR seems likely. This will depend on the emerging flow of economic data. So happy to take questions. Yeah, please.
The housing market, what is the forecast for that in Auckland? Do you think you've got on top of it, or any sign that it's starting to cool down?
A little bit early to say whether it's cooling down. The index that we look at very closely is the Rhines Stratified Index. And we tend to look at what's happened in the last 3 months and compare it to the 3 months of the year before. I mean, that takes out a lot of the noise in the system. And the Stratified Index tries to adjust for basically avoiding a situation where you've got a whole lot of expensive houses affecting the index from one month to another and that sort of thing. So that's running at around 24.5%. The Rhines data is out, I think, in the next couple of days. So it was 24% for July in that 3-month period over the previous 3 months. So we'll take a look and see what the new data shows. I think what's worrying is if you look at the house price to income ratio in Auckland, it's around 9. For the rest of the country, it's 4.5. Now, a ratio of 9 puts Auckland house prices in a grouping of cities that are probably in the the most expensive cities in the world. And secondly, if you look at investors' expectations for Auckland, there was a survey, I think, done by ANZ late last year, which indicated that over the next 5 years, investors were expecting house prices to rise by about 12% a year. So cumulatively, that's about a 75% increase. Now, if we do our job properly in the Reserve Bank, the price level will go up by about 10% in that 5 years. So we're watching the Auckland housing situation very carefully. The good news is that permits, residential permits, are running at around 8,500. Now that's quite a step up, about a 20% step up over last year, and it's the highest rate of permits, largest number of permits for about a decade. So that's promising.
Would you introduce income to loan ratios if you can't get on top of it?
Well, in the end, you know, what's required to get on top of the Auckland housing market is to address the supply shortages. And, you know, that's why, you know, these residential permit numbers are so important to see what the trend is there. We've always said that macroprudential policy can really help to try and slow the rate of increase, but it can't solve the Auckland housing problem, not by any means.
So when you say here that it will take some time to correct the imbalances, how long is some time? How many years are you talking?
Well, I think the existing housing shortage, according to some of the council figures, is somewhere between 15 and 20,000 or 25,000 houses. And the Auckland Council said they need basically about 10,000 houses a year over the next 3 decades. So that's the sort of flow dimensions that are required. And permits are currently running at 8,500. Now, part of the challenge is that migration flows are still very strong. So net migration is running at about 55,000 at the moment. Now, let's say half of that goes to Auckland, and let's say that the tenancy rate or the occupancy rate is about 3 per house, which is what it is in Auckland. It's higher than the rest of the country. So that means just dealing with the migration flows, you need about another 8,000 houses or more a year anyway, just to deal with the net migration. So the risk is that this housing imbalance could carry on for quite some time. But what's needed to address it, as I say, is supply.
Governor, just with the reduction in dairy prices, can you talk about how worried you are about dairy debt and if you expect a lot of bankruptcies and any disruption to the economic stability because of that?
I mean, dairy debt roughly is about $35 billion. Now, that's a big increase since 2003 when it was about $12 billion. So it's a very substantial step up. What's interesting about the debt, or to some extent worrying about the debt, is its skewness. So in essence, the 10% most indebted farmers owe about a third of the debt, and the most indebted 20% of farmers own half of that debt. And then if you look at the banking system, roughly about 10% of dairy loans, dairy accounts for roughly 10% of bank assets. That's probably the way I should put it. You know, I take quite a lot of encouragement out of the survey that Federated Farmers announced. William Rolleston last week released a survey that basically said the vast majority of farmers, and I think the figures were about 6% of dairy farmers, only 6% were concerned about the discussions they were having with banks over mortgages. So that was quite comforting. But let me see if John wanted to add anything.
I mean, it's something you're watching all the time. It has two dimensions. One is the financial stability question, which is where you're alluding, but also the impact of what it might do to farm spending, and that flows through to the monetary policy dimension, and particularly if they stop spending, whether that's slows consumption and aggregate demand down. That's probably the focus of today.
In previous monetary policy statements, you've actually put graphs of where you expect house prices to go and where they've been. It's not in this one. Why not?
There's a range of choices and dimensions of what you focus on in any particular statement. From a monetary policy perspective, I think the big story that's shaping the landscape is actually the change in commodity prices. And so you've seen a big run-up in export prices quite significantly, and that was driving a lot of the decisions last year about when we were moving interest rates upwards. We've seen a very marked downshift in those export prices, and that will feed through to investment plans and aggregate demand. And that's the big shift of where we're seeing monetary policy going as we've been lowering interest rates. The house prices themselves are clearly important, again, for a couple of dimensions. But what we're seeing with those house prices focused in Auckland is they're not being transmitted into higher than unusual consumption. And so it's not a big part of the current conjunctural story, but something obviously we'll need to continue to watch.
Governor, are you expecting the government to run perhaps more deficits in the coming years? And if so, do you expect that? Are you wanting them to do so to help you out a bit and keep things stimulated?
And we think, it's a very good question. We think the economy is growing at around 2% at this point. And our forecasts suggest, and they're always conditional projections, but they suggest that the economy might grow at around 2.5% next year and then 3% the following year. The conditions that probably would be needed to create a recession in New Zealand would be something like China slowing dramatically or perhaps moving into a recession. That would certainly create huge problems in Australia and ourselves. Or also if the El Nino impact really took hold and continued right through into the middle of next year or thereabouts, that could have a significant effect as well. The good news is that, the Reserve Bank or the OCR in terms of the current level still has the potential, if we need it, to be reduced substantially. And the government has one of the strongest fiscal positions of any advanced economy in the world. So in terms of monetary and fiscal stimulus, if it is needed, then there's plenty left in the tank.
Governor, last year the Reserve Bank put up interest rates 100 basis points. Do you think that was a mistake?
No, I don't believe it was. You always operate on the information that you have available to you at any time, and monetary policy is always about making assessments about how things might evolve in the next 12 to 18 months. And I think at Jackson Hole, Stan Fisher made an interesting comment. He basically said, by the time you absolutely know what is needed to be done, it's too late. And I think that's the case. If you look at the situation that we were facing last year when we started to raise rates, we were the only advanced economy in the world, based on IMF data, that was running positive output gaps. I don't think anybody, any central banker or any forecaster or media commentator believed that oil prices would fall by 55% from the middle of last year. I don't think any of us saw that dairy prices would fall by a similar amount from February last year. So at the time when we raised rates, we had a positive output gap. We had the strongest terms of trade for 40 years. We had indicators of inflation pressures that were starting to build up. So in terms of the data that we had, I believe they were the right decisions.
Are you reviewing, or are you concerned at all about the inflation modelling that the bank is using, and do you think there's any need to change it?
John, what do you think?
As always, I mean, it is our central mandate. We're looking at it all the time. And there's a lot of activity going on about what's happened with this, if you might call it excessive disinflation. This is not just a New Zealand phenomenon. We've seen it around the world. And there's three elements to the dimension we're looking at. One is, if we've seen it in other countries, is there an international story to it? And what's the spillover from that? And largely we can explain that. You can see the pass-through from the exchange rates, from input prices into the tradable part of the economy. We think we understand that quite well when we can measure it. The second part of the dimension is, have we got a sense of the economy that's not quite right? Is there extra slack? And again, on that front, it looks like we can explain roughly where we are and what that's doing to inflation. Or to put it the other way, the amount of extra slack we would need to explain this missing inflation would be huge. It would be just too large to be plausible. And then the third dimension is really how are people thinking about inflation in this very low inflation environment? So what are people doing in terms of expectations and managing prices? That seems to be the most interesting dimension. So we've got into a low inflation environment, and that seems to be self-fulfilling. And so we've seen inflation expectations, come down from about 2.5. They've settled towards 2, but also people also understand that currently inflation is running less than 1, and they're factoring that into the prices that they're putting out for the next year or so, and that's coming into the plans as well. And that seems to be the most encouraging dimension to explain what's going on.
My question sort of drags on that one a little bit. There seem to have been two changes in behaviour, and I guess the question I've sort of got is, to what extent you think this is a temporary thing or a longer term thing? And one you've particularly touched on, which is the wealth effect from those high house prices that hasn't led to the sort of surge in consumer spending that we've seen in the past. And you've sort of touched on that in your statement, where you're saying, this doesn't, this is what's happened in the past. The other one is that pass through from the lower exchange rate, which hasn't come through yet, and I notice the business opinion surveys still show that people aren't particularly keen to put up their prices. So I guess my question is, are we seeing a longer term change in behaviour by people here, or do you think this is a sort of a temporary thing and the old Adam will re-emerge at some point in the near future?
It would be a pretty bold central banker that basically argued that the exchange rate could go through a very substantial adjustment and wasn't going to be feeding through into tradables prices. If you look at the TWI, it's down 16% since April. If you look at the cross rate with the US dollar, it's down about 29% since April. These are big adjustments. And you would expect that over time that will start feeding through into tradables inflation. Indeed, that's the path that we show in the forecasts. Tradables inflation's been negative for 3 years because of the high exchange rate and because of falling capital goods prices and oversupply of manufactured goods globally. But in our forecasts, we have tradables inflation going from about -2% to +2%. The uncertainty is really around how quickly that'll pass through and to what extent, whether it'll be a complete pass-through or partial. But John, did you want to add anything?
Yeah, I'll just pick up on the question about the wealth effect and house prices. We were seeing in the previous cycle the household sector spending more of its income than it actually had. So I think we had a savings rate of -9% at the worst point of the cycle. That means basically for every dollar the household sector was earning, it was spending $1.09. I think that's probably the more unusual set of circumstances. And what we're looking at in this set of forecasts is the savings rate being about 3%, or getting towards 3%, so that at least at the moment, the household sector is spending out of its labour income and not out of its potential capital gains on housing. And there is, so we've assumed in this set of forecasts that that will continue.
I think you're a bit surprised by the strength of migration this year. Could you just go through the reasons why you think it's peaked and what are the structural things that are going on in those other countries that would slow it?
Yeah, the migration story has been a difficult one. So the first issue, I think we've seen some shift in the current New Zealand business cycle, so that changes people's employment opportunities, and that will be a big factor in whether people decide to stay here or whether people decide to come as well. So that's the one major factor. We've seen some, when we're looking at early visas and visitor arrivals and so on, we're seeing some sign of change, but you're right, it can change quickly, and we do have to keep an eye on that. But actually the most important thing is not just the physical numbers, but it's the composition that really matters. So in previous cycles, when net migration was very high, we're seeing a lot of demand in the system. The current cycle, what we've seen is a different type of person, so perhaps more students working, and so we've seen this time net migration add to more labour supply in the economy than in previous cycles. So even the very high numbers has had a very different effect.
You mentioned in the statement, you outlined a scenario in which a worsening in global economic conditions would require more monetary policy response. You also mentioned that a dramatic slowdown in China would have a big impact on the economy. Thus far, how close are we to that scenario?
Well, it's a really interesting question, and I think a lot of people are looking very carefully at Chinese data at the moment, particularly given that China has accounted for more than a third of global growth over the last 4 years, and it's also the number one or number two trading partner for over 100 countries. It seems as if investment's starting to slow quite significantly in China. You're seeing it in the manufacturing sector, particularly given the oversupply, as I talked about, of manufactured goods and what's happening to manufactured prices internationally. But you're also seeing it in the residential construction. It's fallen away quite significantly. Now, property prices are picking up in Beijing and Shanghai, but they're still falling in some of the smaller cities. So you've got falling investment or a slowing in investment growth, and given that investment's really propelled the Chinese economy for so long, I mean, the investment ratio in China is about 45-46%. So any slowing in that, people look at very closely. The other thing, of course, or there's two other things. One is the Shanghai index, which went up about 140% in about 18 months and then has come back about 40% since June. But also quite troubling is the capital outflows out of China, which are really quite massive. I mean, as best we can tell in terms of the data, the capital outflows have been about $500 billion over the past year. And in August, it looks as if they accelerated to about $100 billion. So that's substantial capital outflows. You're also seeing, as I say, a decline in the equity markets and some measures that the Chinese authorities have introduced that have raised eyebrows, I guess, in terms of the nature of those measures. So the issue is, in essence, what is China growing at and what might happen in the future. We think it's probably growing at somewhere between 5 and 6.5% at this point. But I think everyone's looking at it closely. The big worry would be if China really started to significantly devalue the renminbi. Now, you've seen an adjustment over 2 days, which was about 3.5%. You've seen the authorities basically say they want to stabilise the RMB. But if there were to be very substantial depreciation of the RMB, it would certainly export deflation around the rest of the world. So I think everybody looks closely at China.
Can you say any more than you have in previous monetary policy statements about where you think the neutral interest rate now lies?
John, do you want to?
Obviously, something we've been looking at quite intensely. I mean, the interesting thing, if you take our view about neutral over the last decade, we think it's been declining at a rate of about 3 basis points per quarter. So we have seen a decline, but it's very steady. So it's not something which you change meeting by meeting. It's a sort of broad guidepost. But it's also something you can't ignore, because if you take that decade, that's 120 basis points. So that becomes quite substantial over a longer period of time. Right now, we haven't actually gone through a process where we think it needs changing at this meeting. But if you're taking, 3 basis points per quarter, you should be thinking the bank would be making a change, once every 2 to 3 years to get across some threshold. Right now, what's really important is the gap between neutral and where interest rates are being set has to be widened to stabilise both output and inflation. So that's the really important message.
John, we have a publication coming out in the next few weeks, don't we? A bulletin article on.
So there's an analytic note which will give all the details about how we measure neutral, what our best view is at the moment, and that will be coming out in 2 weeks' time.
Just want to ask a quick question about the reduction in the number of your rate decisions from next year. You're going down to 7, which, as far as I can tell, is fewer than most other comparable central banks, and it leaves you with a 3-month gap over summer. Why are you doing that, and do you not have concerns about that sort of a gap, particularly in a very sort of fast-changing world?
In essence, we're doing it because, it's partly linked or largely linked to the timing of stats releases, and particularly some key system of national account releases, GDP in particular. So we're in a situation where we've been doing a lot of our forecasting, and then basically a week after we deliver a monetary policy statement, the previous quarter GDP number comes out. And so we want that data at the beginning of our forecasting process. Now, one thing that we've done in the last couple of years, we do a lot of on-the-record speaking about the economy. I think last year we gave about 18 on-the-record speeches or so. So they, we think they're pretty helpful in terms of guiding the market, in terms of how we're thinking about the economy. But, John, did you want to add anything?
A couple of small points. First is there still will be 4 monetary policy statements, which contains the extensive information that we provide. What we're skipping out, if you like, is one simple review between periods. All we do is simply update the numbers and then issue a one-page press release. I think, in the modern day, when things are really moving as fast as you suggest, and I agree, is actually it's better, rather than just giving a simple one-pager, is actually to give a full speech. And whether that's one of the governors or Graham himself, that's probably a better approach to when things are changing.
And presumably, if you needed to act over that 3-month period, you could do so outside of an official policy
Absolutely.
meeting. Right.
Yep.
Governor, just on the, you said that you're watching China very closely with the reduction in or the slowing economy there. The sort of counter-argument has been that dairy products will sell no matter what, that people need to eat, and that, in fact, protein consumption is going up in China despite the slowing economy. So how do you balance those two ideas?
No, it's a great point. I mean, if you look at the Chinese economy and the components of demand, the investment ratio is around 46%. The consumption ratio, consumption as a share of GDP, is about 37%. The good news is that consumption is still growing in China at around 8%. And if you look at the urbanisation rate in China, it's around 52%. So that's well short of advanced economies where it's around 75 to 85%. Now, what happens with urbanisation is that basically incomes in cities are higher than in the rural districts. Productivity is higher in cities than in the countryside, for example. So given that, one, China is embarked on a strategy to try and raise its consumption ratio, and given the fact that that's currently growing, as I say, at around 8%, plus you've got all this potential urbanisation over the next 2 decades or more, then, that's very promising for us.
Just going back to Auckland house prices and macroprudential policy, won't today's drop in the OCR have more than a cancelling effect than any dampening from the macroprudential policies? And also, there's been some discussion recently about whether the governance structure of the Reserve Bank should change, and instead of just having the governor making the decisions, there be a board. Do you have any views on that?
A couple of questions here. So on macroprudential policy, what we've indicated is that we think the measures that we're taking around investor-related lending have the potential to slow house price inflation in Auckland by around 2 to 4%. Now, it's certainly true that you've seen a reduction in mortgage rates that's quite substantial over the past year. I think since the middle of last year, if you take 2-year fixed rates, they're down about 1.75%. They're down over 1% since the beginning of this year. So clearly, as we ease monetary policy, that certainly has an impact on the housing market, and it's something that we think about very significantly. On the governance arrangements, there's, I think, a misunderstanding about how we take decisions in the Reserve Bank, and I gave a speech on this about 18 months ago or so, where we talked about the governance committee or the governing committee. What in fact we do is we have 3 days of very intense discussions. So leading up to this monetary policy statement, for example, we have 3 days of very intense discussions, probably with about 35 colleagues around the room, presenting on the economy, presenting on forecasts, discussing risks, discussing the external economy, and all of that. Then we do, during those 3 days, we do simulations about what if that, and in the end we agree on a set of forecasts and take a monetary policy decision. Now, that monetary policy decision is taken by a committee, in essence. Well, let me put it this way. There's a committee of 12 people that give advice to the 4 governors on what should be the monetary policy recommendation. 2 of those members are people outside the bank. They come in 4 times a year for every forecast week that we have, these 3 days of intensive forecasts. And they are part of the group that give advice to the 4 governors. Now, the 4 governors then make the decision based on their own views and the advice that they've received from the committee. So it's a committee that's operating here. Now, there hasn't been one example of, at least in the last decade, of a governor taking a decision that has not been consistent with the committee. There hasn't been one example of that. So it's essentially a committee of governors that take the final decision. It's a committee of 13 people that are giving advice to the 4 governors, and there are 2 outsiders on that committee. So I think there's a bit of a misunderstanding sometimes about single decision makers and committees. So I'm pleased you raised the question.
Governor, you've clearly had in mind a lower OCR for the last few meetings, and you still have that in mind from the comments that you make. Why not whack it down all at once to where you want it to be so that you're at the right level rather than these incremental quarter point slow declines?
Well, we've indicated that, and let me find the exact language because I don't want to create any market volatility. We've indicated that at this stage some further easing in the OCR seems likely. Now that's how we're seeing it. If you look at our forecast track, there's 50 basis points of interest rate reductions built into that. We're taking 25 basis points of that adjustment today. But we've also said that this will depend on the emerging flow of economic data. So we will look carefully at things like, dairy auctions, what's the outcome there, what's happening on the inflation side in terms of CPI and other inflation measures, what's happening to inflation expectations, what might the Fed do in September. So there's all sorts of data, including migration and other things, that we will look at. Did you want to add anything, John?
Yeah, I mean, things can always happen. Again, one of the big parts, thinking about what's shaping the outcome on the forecasts is export prices, and particularly dairy. So I'll just give you an example. In our forecasts, we think, the dairy price is something like $1,500 per tonne. We think that's going to be around for a while. But actually, if you took today's spot price, it's already 2,000. So things can change. And so if you try to accelerate all your decision making, what you could end up doing is amplifying volatility in the economy and the marketplace rather than actually try and smooth it.
Governor, Box D in the monetary policy statement talks about an alternative scenario involving weaker global economic conditions and suggests the Reserve Bank could cut the official cash rate to 2% if that happened. What sort of global events would be the trigger for or in line with that sort of alternative scenario? And what sort of chances do you think we might see that alternative scenario?
Well, I think, what would cause a slowdown in our economy, as I said before, one would be if the El Nino effect really did become very significant and prolonged. That would certainly affect dairy incomes, farm incomes more generally, and feed through to the economy rapidly. The other, I think, is, if China really did start to slow dramatically, and I talked about China before. The other, I think, if you look globally, the US economy looks to be growing pretty strongly now. The last quarter was an annualised rate of 3.7%. The unemployment rate is down to 5.1%. There was some strong labour data out this morning out of the US. So I think everyone's very interested in what the FOMC might do on the 17th or thereabouts. Europe, it looks as if, inflation is possibly a bit weaker than the ECB thought. Maybe growth may not be quite as rapid. The slowdown is basically occurring in the developing countries at present. So it's, it's South Africa, it's Brazil, it's Russia. India's doing fine. China, as we've just talked about. So it's that region plus East Asia in general.
On that,
but did you want to add anything, John?
There's a whole range of scenarios that are possible. Actually, putting a probability on them is not a task that you can assign a concrete number. What's important if things happen, and I think in my mind China was perhaps the most dominant. It's important that on the financial markets know how we will react. And so that was the key message of the box, that if these things start to happen, and people are talking about it, it's not the central scenario, but we have to prepare just in case. And this is the type of reaction we would take.
On that Fed decision, what are your views on what you think the Fed might do, and how did that feed into the decision and the forecasts today?
I think everyone's hugely interested in what the Fed might do, because it's almost a decade since they raised rates, and it's probably whenever they do make that adjustment, it's going to be the most telegraphed decision of any monetary policy decision in the world. So you've really got a vast difference in views. I mean, you've got the IMF who've said postpone it till next year. The World Bank this morning, chief economist, came out and said the same thing. There's an article in the Financial Times this morning by Larry Summers, again putting the case for holding off a decision, which he made also 2 weeks ago. If you look at the markets, they're building in a probability of around 35% or so at this point that the Fed will move. It's clear that that some on the Fed governors that there's differences in view about the timing. I mean that's very clear. If you look at their twin mandate, then with unemployment down at 5.1%. And very strong job opening growth for August, you might argue that that part of their twin mandate of maximising employment has been met. So the issue is what's happening in terms of price stability and the inflation pressures are they facing? And then, you look at what's happening to the PCE deflator, which is what they look at, the private consumption expenditure deflator, and you look at what's happening in the labour market in terms of wage increases. And it'll be partly that drives, one suspects, their decision, and the other thing will be how much volatility is there in the global financial markets. And everyone saw what happened with the decoupling issue and, what's the expression? The tampering issue, the taper tampering in, what was it, around August 2013. Well, thanks very much indeed.